Advanced Auditing and Assurance lesson. In our today's session, we are going to study the role of audit committee in the audit process. This is the last lesson under the topic audit evaluation and reviews. We've so far covered audit assertions and how to identify relevant assertions during the audit process. We covered the subsequent events. We looked at the going concern assumption as a financial statement risk. We studied related parties. Under related parties, we looked at the risks associated with related parties, the process of identifying related parties by management, disclosure of related parties in the management representation letter and the financial statements. Another subtopic under this topic is drafting management representation letter. We also did look at the group audit, the joint audit, and the component audit. We learned how to prepare the group reporting instructions to component auditors. In subtopic number 7, we looked at the analytical reviews. In number 8, we covered evidence and testing considerations. In subtopic number 9, we looked at using the work of experts such as tax experts, valuers, lawyers, and so on. In number 10, we covered 4 areas under the company audit. The first one being the audit of financial statements. Number 2, audit of banks and non-banking institutions. Number 3, audit of general insurance companies. Number 4, we covered the audit of cooperative societies. Number 5, we did the points to consider when auditing the taxation laws. In our last session, we looked at other special audit assignments. Today is a last lesson in audit evaluation and review, which is the role of audit committee in the audit process. The audit committee candidates plays a crucial role in the audit process. It does what? It plays a crucial role in the audit process. The audit committee may have other roles, but it also has a crucial role in the audit process. It serves as a key oversight mechanism to ensure that the integrity and the effectiveness of the organization's financial reporting and auditing activities. So, what are the primary responsibilities of the audit committee in the audit process? That's what we are going to study in our today's lesson. And therefore, by the end of this lesson, you should be able to explain the role of audit committee in the audit process. We are going to study several roles. One is independence and objectivity. A role related to independence and objectivity. Now, candidates, an audit committee is a committee that is set up by the board of directors, and the members who sit on the audit committee are non-executive directors. An audit committee consists or should consist of independent directors who are not involved in the day-to-day operations of the organization. Why? Because such independence ensures that the committee can provide unbiased oversight. Such committee can challenge management's actions when necessary. So that's one important role of an audit committee: independence and objectivity. Another role that the audit committee plays in the audit process is the appointment and oversight of the external auditor. The audit committee appoints the external auditor. The audit committee also oversees the external auditor. The audit committee is responsible for the selection and the appointing of the external auditor. This committee also monitors the auditor's independence, monitors the auditor's objectivity and performance, and that includes reviewing and approving the audit engagement letter, discussing the scope of the audit, and evaluating the adequacy of audit fees. That's the second role of audit committee in the audit process. 3, financial reporting oversight. Financial reporting oversight. The audit committee reviews and provides oversight of the organization's financial reporting process. They ensure that appropriate accounting policies are followed, significant financial reporting issues are addressed, and financial statements are prepared in accordance with applicable accounting standards and regulatory requirements. That's the role of the audit committee. Number 4 is a role related to internal control and risk management. Internal control, and risk management. Internal control and risk management. The audit committee assesses the effectiveness of the organization's internal control system and also the risk management processes. This committee reviews the adequacy of internal controls to safeguard assets, to protect the company against fraud, and also to ensure the accuracy of financial reporting. And that may include monitoring the implementation of recommendations from internal and external auditors. 5, communication with auditors. Now, an audit committee maintains regular communication with the external auditor. And through this communication, they discuss audit plans and findings. Through this communication, they address any concerns or issues raised by the auditor and ensures that management takes appropriate actions to address identified weaknesses and deficiencies. Communication with the auditor. Number 6, whistleblower protection. Whistleblower protection. The audit committee establishes and oversees mechanisms to enable employees and even stakeholders to report any concerns or suspected improprieties confidentially without fear of reprisal. Whistleblower protection. This committee ensures that there are appropriate measures, all right, in place to investigate and address reported concerns. Whistleblower protection. So it is the role of the audit committee to ensure that whistleblowers are protected. Number 7, legal and regulatory compliance. Legal and regulatory compliance. The audit committee monitors the organization's compliance with relevant laws, regulations, and ethical standards. This committee reviews the adequacy of systems and processes in place to identify and address legal and regulatory risks, including those related to financial reporting and auditing. they have a legal and regulatory compliance role. That's number 7. Lastly, they have a role to play in relation to reporting and disclosure. Reporting and disclosure. The audit committee provides reports, it provides recommendations to the board of directors on matters related to the audit process, on matters related to financial reporting, on matters related to internal controls, as well as matters related to risk management. This committee also ensures that the organization's financial statements and other related disclosures are accurate, complete, and transparent. So these are 8 roles of audit committee in the audit process. Number 1, independence and objectivity. Number 2, appointment and oversight of the external auditor. Number 3, financial reporting oversight. Number 4, internal and risk management. Number 5, communication with the external auditor. Number 6, whistleblower protection. Number 7, legal and regulatory compliance. Then lastly, reporting and disclosures. So in summary, candidates, the audit committee acts as an independent and objective body that enhances the credibility and reliability of the audit process. And their oversight and involvement contributes to the integrity of financial reporting, the effectiveness of internal controls, and the overall governance of the organization. So that's all as far as the role of audit committee in the audit process is concerned. Thank you for attending the lesson. In our next session, we are going to begin on a new topic, which is audit-related assurance services. Audit-related assurance services. Thank you. Bye-bye. Greetings, candidates, and welcome to the lesson. The subject is financial management. Today we're going to start on a new chapter known as the financing decision. Candidates will recall in our first lesson we did mention that the finance manager performs 4 crucial roles, 4 key roles. One of them being capital budgeting decision, financing decision, working capital decision, and also the dividend policy decisions. Those are the key decisions that the financial manager makes. Today we begin the discussion of the second crucial decision that is expected of a financial manager, that is the financing decision. This chapter is arranged into 5 subtopics. Number 1 is the nature and objectives of the financing decision. Number 2, factors to consider when making financing decisions. Number 3, sources of finances for enterprises. Under the sources of finances for enterprises, we'll discuss the internally generated funds and the externally generated funds, the long-term sources, the which include equity, debt, hybrids, lease finance, venture capital, business angel finance, private equity, asset securitization and sale, Islamic finance, and initial coin offerings. We also tackle the medium-term sources such as medium-term loans and hire purchase financing, as well as the short-term sources of finance such as the overdraft, trade credit, issue of commercial papers, accruals, deferred income, and also the characteristics of each source of finance. We will be studying the characteristics of each source of finance, the pros and cons of the various sources of finance will also be covered in the subtopic sources of finances for enterprises. Then in subtopic number 4, we will discuss the evaluation of financing options. Then lastly, there is the methods of issuing ordinary shares. We look at the public issue, the private placement, bonus issue, employee stock option plans, and rights issue. So that is what is expected of you as far as the chapter on the financing decision is concerned. And before we get into the objectives of the financing decisions, I'm going to make a few comments about the financing decisions. Now, candidates, the financing decisions are decisions regarding the methods that are used to raise funds which would be used for making acquisitions. The financing decisions are decisions concerning the liabilities and also the stockholders' equity side of the firm's balance sheet, such as decision to issue bonds. When looking at the financing decisions, candidates, we are considering the right-hand side of the balance sheet, which comprise the capital and also the liabilities. By now, I'm sure you know that there are two sides to a balance sheet, the debit side and the credit side. Under financing decisions, we'll be considering the items that appear on the credit side of the balance sheet. So the financing decisions, candidates, involve various factors, and they are the expenditure analysis. They involve raising funds on the most favorable terms possible, and also managing the working capital, such as the inventory, the accounts receivable, and so on. So a finance manager is expected to help the company to raise funds on the most favorable terms possible. And the goals of corporate finance candidates can be achieved only when the corporate investment is financed appropriately. And there has to be what we call the financing mix. Why? Because the financing mix will make an impact on the valuation. And the company should therefore identify what we call an optimal mix of financing. All right? That means the one which results in maximum value. So the finance manager is expected to help the company come up with an optimal mix of financing. For example, if a project is to be financed, the finance manager should be able to tell what will be the proportion of money that will be raised out of debt, what will be the proportion that will be raised out of capital, share capital, and so on. Why? So that the goals of corporate finance can be achieved. And that goal can only be achieved when there is a financing mix, when the results lead to what we call maximum value. And candidates, the sources of finance are usually comprised of combination of debt and equity financing. And we all know that a project that is financed through debt results in a liability and obligation. If a project is to be raised through debt, then that debt will result into a liability and an obligation. And when a project is financed through equity, it is less risky. It is what? It is less risky with respect to cash flow commitments. When a company raises money through equity, then that company does not have to be servicing loans every month. All right? So the cost of equity is always higher than the cost of debt. The equity candidates financing may result in what we also call an increased hurdle rate. So the management of the company must match the financing mix to the asset that is being financed. And one of the theories as to how the firm makes their financing decisions is the pecking order theory. The pecking order theory. Pecking order theory. This is one of the theories. And what is the pecking order theory all about? Candidates, under this theory, under the pecking order theory, the firm should avoid external financing if it has availability of internally generated funds. Pecking order. The firm should avoid external financing like debt if the firm can make use of, say, retained earnings, internally generated financing. If the firm can raise money internally under pecking order, the firm should avoid external financing. The firm also, candidates, should avoid equity financing if they have an option of debt financing which is lower, okay, which has a lower interest rate. If a firm has a lower, can raise debt at a lower interest rate, the firm should go for debt financing if the interest rate is lower. I also mentioned that under pecking order, a firm should opt for internal sources. If the firm has internal sources of finance like retained earnings, then the firm should exhaust the internal sources before the external, because generally the external sources of funds is cheaper than the external sources. So the pecking order is one of the theories that can help a finance manager make the financing decisions. And another theory which can help a finance manager to make financing decision is what we call the trade-off theory. The trade-off. Trade-off theory. What is this theory all about? Now, the trade-off theory is where firms are assumed to trade off what we call tax benefits. They assume to do what? To trade off tax benefits with what we call the bankruptcy costs. Bankruptcy the firm can do what? Can trade off the tax benefits with bankruptcy costs when making financing decisions. Bankruptcy costs. Now, having made the few comments on the financing decisions, let's now move to study the nature and objectives of financing decision. Nature and objectives of the financing decision. Now, candidates, the nature of financial decisions vary from one farm to the other. And it may be also different for the same farm over a period of time. It may also be what? Different for the same nature of farms over a period of time. So it's important to note that the nature of financial decisions vary from one farm to the other. And even the farms which may seem the same, the nature of financial decisions can also vary over time. And the reason is that the nature of financial decisions is influenced by prevailing microeconomics and macro conditions. Macro and micro conditions. The what? The reason why the nature of financial decisions vary from one farm to the other is that the nature of financial decisions is done what? Is influenced by the prevailing microeconomic and macroeconomic conditions. Macro and micro. Microeconomic and macroeconomic conditions or factors. Microeconomic conditions, macroeconomic conditions. Now let's try and understand microeconomic conditions. Now, candidates, microeconomic conditions or factors are factors that are related or conditions that are related to the internal conditions of the farm. Microeconomic conditions are the factors that are related to the internal conditions of the farm. Internal conditions of the farm. Now, the important among these conditions, these are the internal conditions. One of the internal conditions is the nature and size of the farm. One, nature and size of the farm. The nature and the size of the farm. The nature and the size, because we have small farms, we have large farms, we have private farms that are run by families, we have farms that are incorporated. So the nature and the size of the farm is an internal condition that will determine the financing decision that will influence the internal or the financing decisions of the farm. The nature and the size of the farm. 2, the level of risk. The level of risk. And this can be established or determined by looking at the stability of earnings. Let me just put and stability of earnings. There are farms whose earnings are stable. There are farms whose earnings are not stable, not predictable. So the level of risk and stability of a farm is an internal condition, Number 3, liquidity. The liquidity position. There are farms that are liquid, there are those that are not liquid. Asset structure. Number 4, asset structure is an internal condition. Asset structure. The asset structure of a farm is also an internal condition. The asset structure of the farm, as well as the pattern of ownership and the pattern of ownership. Asset structure and pattern of ownership is an internal condition which may influence financing decisions, Another internal condition or factor is the attitude of management. The attitude of management. So let's discuss some of these microeconomic conditions in brief, starting with the nature and size of the farm. How is the nature and size of the farm? How does the nature and size of the farm influence financing decisions? Now, candidates, if a farm is engaged, for example, in manufacturing operations or in the provision of public utility services, its investment in fixed assets is large, and hence the capital structure has a large share of long-term capital. And the share, candidates, the share of long-term capital in the capital structure will also be large in farms that produce capital goods. On the other hand, in trading companies or concerns, a greater part of the investment is found in current assets. I'll give an example of a supermarket. A supermarket is most likely to have a larger part of its investment in stock, as opposed to, say, Toyota company, which engages in production of capital goods. So the investment of Toyota in fixed assets will be larger, and therefore the capital structure will have a larger share of long-term capital. But in trading concerns or companies who buy finished goods and sell finished goods. Those are trading concerns. They do not manufacture. So you'll find that the greater part of the investment is found in current assets. And with a greater ratio of current assets, the ratio of current liabilities also rises. And similarly, companies that are larger in size need larger capital. We are discussing size. We will discuss the nature by looking at the nature. The nature could be, say, a manufacturing farm and a trading farm. That's the nature. Size, we have a small company and a large company. Companies that are large in size, companies that have, say, 1,000 employees, will need large capital. Even just working capital, paying salaries, paying rent, paying for office space. See, that will require large capital as compared to a small firm of, say, 5 employees. All right, a firm that has just 5 employees, that's a company that do not need large amounts of capital. Small firms may obtain their fixed assets just, say, on lease or hire, but large firms would need to construct their own buildings. They may need to assemble their own plants and so on. So small companies will have lower goodwill in the capital market. And so their financing decisions are different from that of larger firms. Larger firms will find them trading in stock exchanges and so on. And it is because of the lack of sufficient goodwill in the capital market that small firms are largely dependent on internal finances. And that is one of the reasons that their dividend decisions are different from that of large organizations. The dividend decision candidates, as we'll be studying later on, is also dependent on the earnings of a company. A company that relies on internal sources will have a different dividend policy from a company that gets its sources from, say, the capital market. Because if a firm gets its sources through maybe shares, then such a company is obligated to pay dividends to shareholders. But if a firm has generated these funds internally, then you see that company's dividend decision may be different. So you can see how the nature and the size of a firm, you can see how it affects or influences financing decisions. Then there is a level of risk and stability of earnings. Level of risk and stability of earnings. Candidates' risk is another important factor influencing financing decisions, because the greater the risk, the higher the discount factor. And therefore, risk influences the long-term investment decision or capital budgeting decision. Again, if risk is higher or if income is not stable, risk being higher means unstable income, then the finance manager tries to impress the shareholders for more retention of earnings rather than adopting a liberal dividend policy. But with stable income, with stable income or lower risk, because a company that has a stable income is a company that has a lower risk. So if the income is stable, in other words, if the risk is lower, the financial decision will be just the reverse. And in such a case, the fixed cost capital such as the preference shares and debentures may be preferred. All right? If a company has stable income, then that company can easily service loans, can easily pay interest on debentures, can pay fixed dividends to preferred shareholders and so on. So you can see how level of risk influences financing decisions. A company that has unstable income is a high-risk company because of the instability in earnings. Such a company cannot easily raise money through loans or debt. And the management may go for, say, internal sources. And if a company relies on the internal sources, that means that the shareholders may not be paid. because shareholders are paid out of earnings. If they are not paid dividends, then it means the money is being retained. So the dividend policy of such a company will be different from a company that has stable income. A company that has stable income can easily get sources from external sources, from debentures, from preference shares, from loans, and so on. Do you understand how the level of risk and stability of earnings influence financing decisions? If you don't worry. If you don't understand what I'm talking about here, don't worry, because we shall be repeating what I'm talking here when we discussing dividend policy decisions. We'll also talk about it when discussing capital budgeting decisions. So let us proceed to the third factor. We are discussing microeconomic conditions that are related to the internal conditions of a firm that influence financing decisions. Number 3, we have liquidity position. Liquidity position. This is the third factor that influences the financing decisions. And candidates, since dividend is normally paid out of cash, firms with a sound liquidity position adopt what we call a liberal dividend policy. But if in such cases the working capital requirements are very large, or the firm has to meet significant past obligations, then it will have to follow a conservative dividend policy. Conservative dividend policy. What do I mean? What do I mean when I say a firm having a sound liquidity position? A firm that has a sound liquidity position is a firm that has at its disposal cash. Liquid is just money. A company that has financial resources that are in monetary terms. That's a firm that is liquid. You may find a firm that is more liquid, another one is not liquid. Not liquid means a firm that does not have sufficient money or financial resources to meet its short-term obligations. A firm that is unable to meet its short-term obligations is a firm that can be described as having what we call unsound liquidity position. A firm that has at its disposal sufficient money to meet its short-term obligations is a firm that has a sound liquidity position. Do you understand, candidates? So, candidates, because dividends are normally paid out of cash, firms with sound liquidity position can adopt a liberal dividend policy. Liberal dividend policy means that a firm that distributes its earnings to the shareholders in form of dividends. Liberal, easily pays out of earnings, pays dividends. A firm that adopts a conservative dividend policy is a firm that instead of paying dividends, the firm uses these earnings to finance its obligations. All right? The working capital requirements. If the working capital requirements are very large, working capital requirements would relate to things like payment of salaries, payment of maybe trade receivables, paying debtors, paying the day-to-day expenses, buying inventories, raw materials. Those are working capital requirements. If the working capital requirements are very large, then a firm may adopt a conservative dividend policy. A firm will choose not to pay dividends. That means a firm will use this, the little cash at its own disposal to finance. Remember, we are talking about financing decisions. And this financing decision would also relate to financing of the working capital requirements. So the liquidity position of an organization can influence the financial decisions. Then moving on to the fourth internal condition, or what we are calling the microeconomic condition, is the asset structure and pattern of ownership. Again, candidates, in a closely held company where the ownership is in few hands, the management does not find it difficult to persuade the owners to accept a conservative dividend policy. Now, I'm repeating, candidates, a conservative dividend policy is a policy where the company chooses not to pay dividends to the shareholders, but retains the money for financing of the projects of the company. A company that adopts a conservative dividend policy is a company that chooses to use the internal sources of finance to finance its projects instead of paying dividends. So if pattern of structure, we're talking about pattern of structure. If a company ownership is in few hands, if it's owned by, say, 2 people or 1 person, then it becomes easy for management to convince this 1 person to hold on until the company's finances are stable, to hold on until the company can maybe have enough cash to pay earnings. It's very easy to persuade a small group of people to accept a conservative dividend policy in the interest of the firm. But in cases where there are many shareholders, 1,000 shareholders, then their wishes also matter considerably. It's not easy to convince 2,000 people to hold on. It's not easy to convince such a large number of owners to accept a conservative dividend policy, because these many owners have varying needs. They have varying wishes, and their wishes matter considerably. So the asset structure and the pattern of ownership influences financing decisions. Then lastly, there is the attitude of management. Now, how does attitude of management influence financing decisions? Attitude of management. Here we are referring to the attitude of management in relation to things like risk. Now, a conservative finance manager will attach greater importance to liquidity rather than to profitability. On the other hand, an aggressive finance manager will stress on profitability and not liquidity. A conservative finance manager is one who does not take higher risks, because to attain high profitability, then it means that one has to engage in risky projects, to undertake risky projects. That's kind of endeavors are not pursued by conservative finance managers. Conservative finance managers would rather go for liquidity, holding cash rather than investing in risky projects. But an aggressive manager would go for risky projects in order to attain high profitability. For example, a conservative manager attempts to tread on what we call a beaten path. That's a conservative manager. Will not go into new ventures, risky projects, no. Such a manager will prefer to avoid the fixed obligations for raising additional capital. Even when debt is advantageous, such a manager will shy away from debt. And the preference is to maintain a large volume of current assets. All right? A large volume of what? Current assets. But an aggressive finance manager is one who is ready to bear risk that is involved in debt financing. Because for a company to undertake new risky projects, then a company may need to raise money, and that money may have to be raised through debt. So you may find such a manager getting involved in debt financing and or involving himself in having low current assets. But we can say here that a prudent manager is one who would prefer a compromise between risk and return, or between profitability and liquidity. So the attitude of the manager can also influence the kind of financing decisions that are taken in a company. Do you understand? There are managers who are aggressive, that is an attitude. There are managers who are conservative, that's an attitude. So a conservative manager will prefer holding current assets, holding cash, maintaining high current assets. An aggressive manager is one who may go for risky projects in order to attain high profitability for the company. So you can see that the attitude can influence the kind of financing decisions that are made in a company. So candidates, that will bring this lesson to an end. We just introduced the financing decision. And at the beginning, I mentioned that the financing decision is one of the crucial decisions that are made by financial managers. If you are a finance manager, then one of the main roles that you will play is helping the company make the financing decision. And we've, in today's lesson, introduced the subtopic on the nature and objectives of financing decisions. We've said that financing decisions can be influenced by microeconomic conditions and macroeconomic conditions. In today's lesson, we discussed the microeconomic conditions that affect or influence financing decisions. We discussed 5 factors. The first one is nature and size of the firm. Number 2, the level of risk and stability of earnings. Number 3, liquidity position. Number 4, asset structure and pattern of ownership. Then lastly, the attitude of management. I'll leave you with an assignment. Discuss 5 microeconomic factors that may influence the financing decision of a firm. I repeat, discuss 5 microeconomic factors that may influence the financing decision of a firm. Make sure the assignment is done before you attend our next session. Thank you. God bless you. I remain yours truly, Philip Ndeda Sagwa. Bye-bye. Hello candidates, welcome to Manifested e-learning platform. It's my pleasure to welcome you once again to our today's learning session. The subject is financial accounting and the topic is introduction to public sector accounting. Our today's lesson is a continuation of a series in lessons in public sector accounting. So far we have learned about the features of public sector entities. We have covered the structure of the public sector. Currently, we are on the subtopic regulatory structures. And under regulatory structures, candidates, we have learned about the International Public Sector Accounting Standards Board, the Public Sector Accounting Standards Board, which is the Kenyan version. Then we have also covered the Directorate of Accounting Services in our last lesson. That's what we did. We looked at the technical directorates under the National Treasury. In our today's lesson, we want to proceed and learn about the National Treasury. The National Treasury. So far, candidates, just to do a quick recap of what we have covered under the topic public sector. Under public sector accounting, public sector accounting, the public sector accounting, we have done the features of public sector entities. We've also done the structure of public sector, Currently, we are on the subtopic regulatory structures. This is our current subtopic. Now, so far under the subtopic regulatory structures, we have learned about the International Public Sector Accounting Standards Board, the Public Sector Accounting Standards Board, then the Directorate of Accounting Services, that is the International Public Sector Accounting Standards Board, the Director of Services. So this is covered under the regulatory structures and oversight. Candidates, if you can remember, we learned that the International Public Sector Accounting Standards Board works under the auspices of the International Federation of Accountants. The International Federation of Accountants. And the Public Sector Accounting Standards Board, we saw that this is a Kenyan version of the International Public Standards Board, and it derives its mandate from the Public Financial Management Act. The Public Financial Management Act. That's where it draws its mandate from. Then we discussed in our last lesson about the Directorate of Accounting Services. We said that this directorate is headed by a Director General, and the directorate is organized into four into 4 directorates. 4 directorates. The first one is the government accounting services. The second directorate is the internal audit department. The third directorate is the financial management information services, the famous IFMIS. Then there is the last department, which is the national sub-county treasuries. So these are 4 directorates, and we gave 19 functions that are performed by these 4 directorates. And the Director General of the Directorate of Accounting Services reports to the Cabinet Secretary, National Treasury. And today, candidates, we want to study the establishment, the mandate, and the functions of the National Treasury. The National Treasury. The National Treasury. That's going to be our subject of our lesson today, the National Treasury. And here is the lesson objective. By the end of this lesson, you as the candidate should be able to explain the establishment, the mandate, and the functions of the National Treasury, which is a regulatory structure under public sector accounting. That is the lesson objective. Now, candidates, the establishment. What can we say about establishment of National Treasury? Establishment. Now, the National Treasury derives its mandate from the 2010 Constitution, number 1. Number 2, the Public Financial Management Act of 2012 and the Executive Order number 2 of the year 2013, which was about organization of government. So the National Treasury draws its mandate, or we can say, draws its mandate from number 1, the Constitution, and specifically Article 225 of the Constitution. Number 2 is the Public Financial Management Act of 2012, and number 3 is the Executive Order number 2 of the year 2013. Now, candidates, this article 225 of the Constitution says, and I quote, "An act of Parliament shall provide for the establishment, functions, and responsibilities of the National Treasury." That is what the Constitution states under Article 225, and the article is about financial control. Financial control. Article 225 is about financial control, and it says that an act of Parliament shall provide for the establishment, functions, and responsibilities of the National Treasury. If I was to remind you, candidates, this Constitution was promulgated in the year 2010. All right, in 2010, the Kenyan citizens, through the Constitution, decided that an act of Parliament shall provide for the establishment, the functions, and responsibilities of the National Treasury. And that act, candidates, is the Public Financial Management Act, right, of the year 2012. And you can see after the year 2012, the President, through the Executive Order number 2 of 2013, organized his government, because this executive order again is titled Organization of Government. The executive order, the second one in 2013, was about organization of government, and it superseded the executive order, the presidential circular of the year 2008. That's the history, okay, and establishment. So we have learned about establishment. How was it established? It's through these 3 articles, all right? The Constitution, an Act of Parliament, and the Executive Order. Executive Order. I hope that is clear enough. Let's now move on to the functions and responsibilities of the National Treasury. We have seen the establishment. We need to move on and discuss the functions of the National Treasury, which is headed by the Cabinet Secretary to the National Treasury. So, functions of the National Treasury. Functions of the National Treasury. Treasury. The pass. This is the pass, the national pass. The national what? The national pass. National Treasury. Now, candidates, the first function of the National Treasury, the first function of the National Treasury, according to the Public Financial Management Act, is that the National Treasury shall formulate, number 1, formulate, implement, and monitor macroeconomic policies, involving expenditure and revenue. Formulate, implement and monitor macroeconomic policies involving expenditure and revenue. That is self-explanatory, because I'm well aware that you have covered macroeconomics. All right. Number 2 is to manage the level and composition of national public debt, national public debt, national guarantees and other financial obligations of the national government. Remember, he's the cabinet secretary is the head of the national treasury. So he's to manage the level of and composition of the national debt, public national debt, national public debt, the national guarantees and other obligations of the national government to manage. That is function number 2. Another responsibility, number 3, is to formulate, evaluate and promote economic development in conjunction with other national government entities, other national government entities. Right? Formulate, evaluate and promote economic development in conjunction with other national government entities, because the ministry cannot on its own promote economic development. It has to work with other ministries and other public sector entities. Right? That is number 3. Number 4, to mobilize domestic and external resources. For what purpose? For financing budgetary requirements. Resources for financing national, we can even say financing both national government and county government and county government budgetary requirements. County government and national government budgetary requirements is supposed to mobilize both from within and from without. All right, domestic and external resources have to be mobilized by the National Treasury to ensure that the budgetary requirements of the national government and the county government are met. Then number 5, function number 5 is to do what? Function number 5 is to design and prescribe. The national government's function, a very important one, is to design and prescribe an efficient what? Efficient financial management system, efficient financial management system for the national government and county governments, supposed to have an S there, and county governments, there are many, and county governments, to ensure the purpose for this efficient financial management system for both the county government and the national government is to ensure transparent financial management and standard financial reporting. There should be standard financial reporting in the national government and the county governments, and that can only work or happen if the National Treasury designs and prescribes an efficient financial management system. So these are 5 objectives, 5 functions. Let's give more functions of the National Treasury. More functions of the National Treasury. Function number 6. Number 6, you can say, in consultation with the accounting standards board, the National Treasury should ensure the uniform accounting standards are applied by the national government, and public sector entities. Okay, public sector entities in consultation with the Accounting Standards Board, and this is the Public Sector Accounting Standards Board. Number 7 is to develop policy. Develop policy for the establishment, management, comma, operation, and winding up of public sector entities. Okay, public sector entities. Learners, the muscle is being exercised. All right, I can feel some gain. All right, no pain, no what? No gain. Number 8 is to prepare the annual division of revenue. And what else? This, if you have television and you watch business news candidates, you will hear these terms on television. Division of revenue and this is division of revenue bill, and the county allocation. The county allocation of revenue bill. Prepare the annual division of revenue bill and the county allocation of revenue bill. So candidates, I once again, I've done this before, invite you to develop interest in business news. Some of the things we are learning here, you can get them on business news, right? You can read business newspapers. On television, every station has segment for business news. These are some of the matters that come up in news. So you must have heard about the division of revenue bill and the county allocation of revenue bill. Number 9, the third function of National Treasury is strengthen the financial and fiscal. Strengthen financial and fiscal relations between the national government and the county governments. Between the national government and the county governments, and encourage support for the county governments. Encourage support for the county governments. That is responsibility number 9. Number 10 is to assist county governments, to develop capacity. Capacity for what? Capacity for efficiency, for efficient, effective and transparent financial management, and transparent financial management. Financial management. Assist county governments to develop capacity for transparent, efficient, effective financial management. Number 11, the 11th function is to prepare the national budget, execute, stroke, implement and control approved budgetary resources and control approved budgetary resources to MDS. MDS means ministries, departments, and agents, and other public sector entities. It's the work of the National Treasury to prepare national budget, execute, implement, and control approved budgetary resources to the ministries, departments, and agencies, and other public sector entities. So these are 11 functions of the National Treasury, which you are supposed to record in your mind. For those who are going to sit for the exam, make sure you have these functions in your memory. Then, peradventure, you are asked a question in relation to the role of the National Treasury in the devolved system of government. Here are the roles. Just in case, you need to understand what is the role of the National Treasury in the devolved system of government. The role or functions or responsibilities. Role of National Treasury, the National Treasury in the devolved system of government. Number 1, the first role is to strengthen financial and fiscal relations between the national government and the county governments, and encourage support for county governments in performing their functions. The second role that the National Treasury plays in the devolved system of government is to assist county governments develop their capacity for efficient, effective and transparent financial management. Transparent financial management. Candidates, role number 3 is to prepare annual division of revenue. Let me have it in capital here. Revenue bill and the county allocation. County allocation of revenue bill. Number 4, candidates, is to coordinate and develop the development and implementation of financial recovery plans. Implementation of financial recovery plans for county governments that are in financial distress. So that is the role. The National Treasury is mandated by law to coordinate the development and application of financial recovery plans for the county governments that are in financial distress. Then lastly is to develop capacity building of county governments on public financial management matters. So these are the roles of the National Treasury in the devolved system of government. So these again, candidates, if you are preparing for exams, make sure you record this in your memory for easy retrieval. So these are the roles of the National Treasury in devolved system of government. Here we have the roles of the National Treasury as mandated by law. The National Treasury is mandated by law to perform these functions and responsibilities. So candidates, that will mark the end of our today's lesson, whose objective was that by the end of the lesson, you as the learner should be able to explain the establishment, the mandate, the functions, and the responsibilities of the National Treasury, which is a regulatory structure under public sector. Thank you for being attentive. I wish you all the best as you prepare for exams, and bye-bye.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners.
What are contingent assets? What are examples of contingent assets? What are the key requirements of IPSAS number 19 in relation to contingent assets? That's what we are going to discuss next. Contingent asset. What is a contingent asset? Contingent assets. Now, a contingent asset is a possible asset. It is, first of all, a possible asset that arises from past event. It is a possible asset. First of all, it is a possible asset that arises from a past event. It is a possible asset that arises from a past event and whose existence will be confirmed only by the occurrence or non-occurrence of uncertain future event, not wholly in the control of the entity. Do you understand? If you understood contingent liability, then you can relate to what we are now talking about, contingent asset. It is a possible asset that arises from, first of all, a past event. It arises from a past event, all right? Such event arises from a past event, first of all, a contingent liability. It is a possible asset. It is a possible asset. It is a possible asset that arises from a past event and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly in control of the entity. And just like contingent liabilities, contingent assets are not measured. They are not measured but disclosed in the notes to the financial statements. Now, to help us understand better, I'll give examples of contingent assets. Examples of contingent assets. What are examples of contingent assets? One example could be proceeds from a legal or pending lawsuit. Let me say pending lawsuit. Proceeds from a pending lawsuit. Proceeds from a pending lawsuit. Proceeds from a pending lawsuit. One, proceeds. A pending lawsuit, litigation. Proceeds from a pending lawsuit. Now, a company may be involved in a legal or may be involved in a lawsuit against a competitor. That's an example. A company where a company is involved, for example, in a lawsuit against a competitor. If the company wins the lawsuit, against the competitor, it could be awarded a significant financial settlement. And therefore, in such a case, the company has a contingent asset for the potential proceeds from the lawsuit. And therefore, the company should disclose the contingent asset in the notes to the financial statements, because it may not be possible to measure what the court will award in terms of maybe damages or the financial settlement. So we've said that contingent assets are not measured, but they are disclosed. So the company, in such an example, is required to disclose in the notes to the financial statements. The company or the public sector entity is required to disclose proceeds from a pending lawsuit. That's an example. Another example is insurance claims. Number 2, insurance claims. Insurance claims. So a company or a public sector entity is may be awarded some money as a result of damage, may be compensated or indemnified. Insurance indemnity, that can also be considered as a contingent asset. 3, tax refunds. Tax refunds is an example of a contingent asset. Tax refund. Government grants. Government grants can go on and on. There are several other types of contingent liabilities. We may also have contingent consideration from a business acquisition, where a company is required to get some money as a result of business acquisition. Contingent consideration from business acquisition. Contingent consideration from business acquisition. Business acquisition. So these are examples of contingent asset. Proceeds from a pending lawsuit, insurance claims, tax refunds, government grants, and also a contingent consideration from a business acquisition. We've defined a contingent liability as a possible asset that arises from past events. It firstly arises from past event that arises from past event and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the public sector entity. And we've given examples. So we now move on to study recognition of contingent assets. Recognition of contingent assets. Now, a contingent asset is recognized when a certain criteria is met. Just like the contingent liabilities, there is a criteria or what we may refer to as conditions. And the first criteria is that the entity should have a possible asset that arises from past event. Possible asset that arises from past event. Possible asset. Proceeds from a pending lawsuit is a possible asset. At the moment it's not, but the company may win a lawsuit against a competitor, and after winning, then that money, cash, becomes an asset, but in future. Insurance claims is a possible asset. Tax refunds, possible assets. Government grants, possible assets. Business consideration from business acquisition is possible asset. So the first criteria is that there ought to be a possible asset that arises from past event. Past event. The second criteria is that the existence of the asset will be confirmed. It will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. It's just like the contingent liabilities. Another criteria is the same as the criteria used when recognizing contingent liabilities. The existence of the asset will be confirmed only by the occurrence or non-occurrence. Occurrence or non-occurrence. The occurrence or non-occurrence of one or more uncertain future events. One or more uncertain future events. For example, proceeds from a pending lawsuit. This may occur. The proceeds from a pending lawsuit may occur in future. May occur in future. The company may receive these proceeds in future. So this contingent liability depends on the fact of the court awarding the company a financial settlement as a result of its lawsuit against a competitor. And you can see the occurrence of such event is not wholly within the control of the public sector entity. It's not wholly. The awarding of this process is not within the control of the entity, but it's within the control of the courts. The third criteria is in relation to the inflow of resource. If it is probable that an inflow of economic benefits will result from the occurrence of the uncertain future event. Inflow of economic benefits. There is likelihood, if it's probable, that there will be an inflow of an economic benefit resulting from the future event, then that's another criteria that can be used by public sector entities in recognizing contingent assets. In recognizing contingent assets. We are now going to study measurement. How are contingent assets measured? And as we have already mentioned, contingent assets, just like contingent liabilities, are not measured, but they are only disclosed in the notes to the financial statements of public sector entities. So I've already answered that question. Contingent assets are not measured. They are not measured. Just like contingent liabilities are not measured, but disclosed in the notes to the financial statements. Are not measured, but they are disclosed to the notes in the financial statements. Lastly, disclosure. What are the disclosure requirements for contingent liabilities? Disclosure. Now, public sector entities are required to disclose certain information about contingent liabilities in the notes to the financial statements. The first information that ought to be disclosed is the nature of the contingent liability. The nature of the contingent, nature of the contingent disclosure requirements. What are the disclosure requirements? Now, candidates, public sector entities are required to disclose certain information about contingent assets in the notes to the financial statements. One is the nature of contingent assets. The nature of contingent assets. That has to be disclosed. There also to be a description of uncertain future event on which the asset depends. A description of a future event on which the asset depends. That also ought to be disclosed. The description of future event on which the asset depends. Then there has to be an estimate of the financial effect of the contingent asset. There has to be an estimate. The entity should be able to estimate the financial effect of the contingent asset. The estimate of financial effect of the contingent asset. Estimate of a financial effect of a contingent asset. That has to be disclosed if practicable. Now, candidates, in conclusion, public sector entities should carefully manage their contingent assets. They should carefully manage their contingent assets. And they should disclose such assets in their financial statements in accordance with International Public Sector Accounting Standard number 9. So that effectively brings the lesson to an end. We've covered the key requirements for provisions, contingent liabilities, and contingent assets. I'm going to give you today's revision questions based on International Public Sector Accounting Standard number 19. The first question is in relation to recognition and measurement. Number 1 reads, how does IPSAS 19 guide the recognition and measurement of provisions in public sector accounting, especially regarding the criteria for recognizing provisions in financial statements? Number 2, what are the key principles outlined in IPSAS 19 concerning the recognition and disclosure of contingent liabilities, and how does it differentiate between contingent assets and provisions? Number 3, in what ways does IPSAS 19 address the treatment of contingent assets? That's one question. In relation to that question, another question is, what criteria must be met for contingent assets to be recognized in the financial statements? Number 4, what specific disclosure requirements does IPSAS 19 impose on public sector entities regarding provisions, contingent liabilities, and contingent assets in their financial statements? Number 5, how does IPSAS 19 recommend handling changes in estimates related to provisions and contingent liabilities? What are the disclosure requirements for such changes? Then lastly, what are some of the common challenges or complexities that public sector entities might encounter when applying IPSAS 19 in practice, especially in determining the existence of measurement of provisions and contingent items? These are your revision questions. Make sure you attempt the questions. If you have any question that you may want to pose, feel free to do so. Below this video, there is a comment section where you can post your questions. You can also get us on our lines. You can write to us. You can call us if you have any query regarding the lessons. Thank you for attending the lesson. In our next session, we are going to proceed with the topic Public Sector Accounting Standards. Thank you. God bless you. Bye-bye. What are contingent assets? What are examples of contingent assets? What are the key requirements of IPSAS number 19 in relation to contingent assets? That's what we are going to discuss next. Contingent asset. What is a contingent asset? Contingent assets. Now, a contingent asset is a possible asset, it is, first of all, a possible asset that arises from past event. It is a possible asset. First of all, it is a possible asset that arises from a past event. It is a possible asset that arises from a past event and whose existence will be confirmed only by the occurrence or non-occurrence of uncertain future event, not wholly in the control of the entity. Do you understand? If you understood contingent liability, then you can relate to what we are now talking about, contingent asset. It is a possible asset that arises from, first of all, a past event. It arises from a past event, all right? Such event arises from a past event, first of all, a contingent liability. It is a possible asset. It is a possible asset. It is a possible asset that arises from a past event and whose existence will be confirmed only by the occurrence or non-occurrence of what